All right, we are live here with Robert Kientz. I'm Elijah K. Johnson. You're listening to Liberty and Finance live stream. All right, again, we are live here with Robert Kientz from goldsilverpros.com. We're seeing the market open right after Silver Squeeze 2.0. Robert, thank you so much for joining us today.
Thank you so much for inviting me on your channel, Elijah. It's always a pleasure.
Definitely. It's great to see you. And I guess before we look at what's happening with metals prices, kind of give us a rundown on your take on the Silver Squeeze 2.0, the 10th anniversary, May 1st. We saw, the beginning of the Silver Squeeze, and it's the 10th anniversary of the crash we saw back in 2011.
Yes. So we did a live stream on our channel yesterday, had a lot of people drop by. Andy from Miles Franklin dropped by, lots of people. Chris from Arcadia Economics, Rafi Farber, a good friend from Seeking Alpha. We had Craig Hemphy from TF Metals and many others drop by, just recounting our experiences of what we saw 10 years ago when silver crashed from 50 to 34 in early 2011. And then again in August, September, it was hammered down again. And then it kind of stayed below, the $40 mark and into the 30s. And we were recounting stories of where we were and what happened. And there was a lot of sentiment that now is the time for silver to reach its true potential. And what I'm seeing is, and you asked me before the show, what am I seeing with Silver Squeeze 2.0? And this is something I predicted after the first one happened. I went on Chris's channel, Arcadia Economics, talked with Andy at Miles Franklin about this, several shows. I think we were going to have a wave 2. And as to when that occurred, it was going to take a little bit of time to build up. Well, we started seeing people talk about the May contract on COMEX, the May contract. Are we going to have a lot of deliveries? And this big movement built on Reddit on Wall Street Silver, where they went from 0 to over 60,000 subscribers. And the sentiment that we have had for silver has just been immense the past couple of months. It is blown up. It is so much bigger than what it was. And what I'm seeing in emails is people are emailing me saying, I'm buying my 100 ounces. I'm buying my 10 ounces. That's all I can afford. I'm buying my 1,000-ounce bar. They're buying what they can and realizing that they want to exchange their fiat dollars for something of longer term value. And so I think it's a pressure cooker. I think there's a lot of interest in a grassroots campaign for people who want to store their money in something valuable. And we're starting to see this just massive demand for silver buildup that I think is so much bigger than what we saw at the end of January and early February in the original version of Silver Squeeze. And again, I'll say this is the second wave. I'll go out on a limb and say, I think we're going to have third and fourth waves. I think this is going to continue as it expands into the public consciousness. I'm seeing more mainstream people interested in silver for the very first time at a level I've never seen. And going back real quick to 2011, I was working as an auditor at a mortgage servicing company back in 2011, the largest subprime mortgage servicer in the US. It was American Home Mortgage Servicing. When silver got close to $50, people around me, because I'd written the book Drop Shadow, The Truth About the Economy, and talked about our economic issues that we had in 2008 and 2009. So people had read that book, they were aware of the precious metals, they got really excited when silver got to $50. But then when silver fell off, interest just died. And it died in a matter of a couple of days, and people just kind of went about their normal business. The difference now, 10 years later, Elijah, that we saw in February and that we're seeing even bigger now, is that silver had only gotten up to $29 in 2020. And it was trading, I don't know what it was, 24, 25, 26 when the Silver Squeeze movement began. It wasn't touching its all-time high, but you saw this grassroots movement without that price having gone to that range, unlike 2011. So we had the Silver Squeeze movement, 110 million ounces pulled off of the London OTC market, put into SLV, and then it just kept building. And so we're not hitting all-time highs, but the amount of interest in people who have never thought about the precious metals is so much bigger than what we saw in 2011. And that tells me it's a genuine movement and a genuine market.
And that's what you've really pointed out, is that there's this movement that's been started. And for anyone joining right now, we're recording at 6 p.m. Eastern on Sunday, May 2nd, right after the Silver Squeeze 2.0. And we're actually going to look now at the silver price, what it's doing right now on the Sunday. Now, last time we had the Silver Squeeze, this was the end of January, beginning of February, we saw a gap up in the metals. And in silver, we saw an increase of about $1.50. Today, though, we're seeing pretty much price unchanged. What is your take on why we're not seeing a price spike in silver right now.
So I think what happened back in January, February timeframe is you had people buying silver. They were going into like the SOV, for example. The SOV traditionally, as sort of a paper proxy of silver price, really affects the movement of the silver price. However, it's not going into SOV now. It's going into retail buying. So people are buying coins and bars, and that's what's driven up the premiums. And on Buffalo Bison's website, they're a retailer. They're actually selling chopped up COMEX bars. So they'll chop up 1,000-ounce bar from COMEX, and it's how many ever ounces it is, and they're selling it at the silver price at a reduced premium because people can't get the retail. But because it's not gone into SLV, it's actually gone more into PSLV. You're not getting that pricing signal. In addition, on the COMEX, we're seeing a lot of shorting in COMEX in terms of the overall short open interest. And I can show charts on that if you like, that the overall short open interest is highest in the two precious metal, gold and silver, when we look at terms of days of production. In other words, how long it takes us to replace that actual physical commodity. These two metals have the highest shorts on the COMEX of any of the commodities, more than sugar or wheat or platinum or palladium or anything that you can trade. It is the precious metal. So there's more short pressure now on those markets than we had the first time. But even though that's occurred, I don't think long-term that's going to stop the price. I think what's going to happen is that price is going to run, but I think what's going to happen is we're going to have this physical shortage, and it's not just going to be the retail market. We've seen that start to hit the COMEX, and so the pressure is building. And if you don't mind, if I can share screen, I wanted to show something printed from the LBMA that you and I talked about last time. I was on the Miles Franklin channel talking about their admission that they essentially had almost run out of silver during the silver squeeze. And basically it came out in a silver 2021 spring report that they had 360 million ounces left. There were 110 million ounces of interest that people had bought through the SLV. It had got pulled off of the London OTC exchange because the ETFs are mostly, they store in London. So 110 million came off. The LBMA came out and admitted in a paper, I think it was sometime in March, if I'm correct, that they were like 2 weeks away from not having any silver whatsoever on the London OTC market. So they were just a couple of weeks away. And now we're seeing on COMEX that silver come off. We've had 40 million ounces of silver come off since late February in the COMEX. So it's not just the retail buying, it's in the big bars. It's being pulled off of actually physically off of the exchanges. And I believe it was last week, I want to say 3 or 4 days ago, I looked at the actual delivery charts from NYMEX, which reports, the warehouse stocks, which reports the warehouse stocks in gold and silver, looked at their Excel sheet for the day. This is, I want to say Thursday's data, if I recall correctly. Almost 2 million ounces have been pulled off net off of the COMEX, out of eligible and out of registered, just off of the depositories. So we're seeing the silver come out of the depositories, the big silver, the 1,000-ounce bars. We saw in February where London almost ran out. It's a derivative market. There's a lot of paper sitting on that. But when people were buying SLV, it was coming out. And another trend that I'm seeing is in the last 4 weeks, if you look at Gold Charts RS on Nick Laird's site, in the last 4 weeks, 7 million ounces have come out of SLV, and 5.7 million of those ounces have gone into PSLV. So people have changed their patterns or getting smarter about how they actually get to real physical, because in the SLV, you can't get the physical unless you own 50,000 shares or you're an authorized participant. So people are shifting from these derivative products to the retail products. Now, it's going to take a little while for that to catch up with the market price, because the market price is determined by derivatives. It's determined on the COMEX by the futures trading in London. It's determined by that spot price and the 2 AM and PM fixes. And the SLV was that signal for the retail market, when that buying came into SLV, that price should rise. So the traders have shifted to the real physical amounts, which is not going to be reflected in those derivative prices. So the price rise will come. It's just going to take a little while, and it's going to be that physical pressure on those big markets that's going to occur. So the second wave will be different from the first wave, but it'll be bigger. It takes a little bit longer to build up that momentum in the second wave, but when it builds, it's going to be bigger. So give it a little bit of time, we'll see that price rise.
And again, for those just joining right now, we are reporting right as the market is opening here right after the Silver Squeeze 2.0. And with us today is Robert Kientz from Gold Silver Pros. Robert, what I was going to ask you about, a kind of a follow-up question on how there's been a lot of ounces of silver coming off of the COMEX. You said, just this Friday, 125 million ounces. So this is not just small investors buying from dealers. This is big money in the silver squeeze game right now.
Yeah, so essentially, if we look at the March data, I'm looking at the CME month-to-date delivery notices for March, and the total delivery of COMEX 5,000 silver futures contracts was 2,987 for the entire month, 2,987. The first day of deliveries for the May contract, which was this past Friday, April 30th, that's the first notice day, was 5,123. So in one day in May, there was 125 million ounces pulled off. That's about an 80% or so increase from the entire month of March. So again, the acceleration of pulling that silver off of the COMEX, is occurring. And so essentially what's going to happen, all the derivative markets that are trading all that paper, like the SLV paper or the futures positions or options contracts, eventually that paper is going to be sitting on dwindling supplies of actually liquid available silver. And the only thing that can happen, that price must go up. In any other commodity, when you have excess demand over supply of the real product, that price goes up over time. And so it must happen in the precious metals. But I think, like I said, the traders have gotten smarter. They're going to the physical, and this time you're not going to be able to tamp down or control that price through derivative trading or measures on the exchanges.
And can you give us an update on what is happening in Sprott's PSLV? I know, I've talked to Rick Rule and how they've had a lot of increase in the amount of silver that they have, right? But your perspective, if you want to give us an update on what's happening right now with the PSLV.
Yeah, the PSLV is a different fund. It's a closed-ended fund, and Sprott is involved with that. There's a lot of trust in the market for anything that Sprott touches for good reason. Been very open, honest, and transparent in this space for a long time. Unlike the SLV and the PSLV, you actually have direct access one-to-one for actual silver. So you don't have to be an authorized participant or have 50,000 shares. And as a closed-ended fund, it allows them to control how many shares are bought versus how much silver they're bringing in. So if there's a shortage of physical silver in the market, they're not selling new shares. Okay. So what we've seen the last 4 weeks is that the PSLV has increased their silver, their actual physical silver, by 5.7 million ounces. That is a huge amount. That's the majority of what's actually come off an SLV. So we've seen 7.3 million ounces in the last 4 weeks come out of the SLV. That's the one where you don't actually have exposure to silver. And we've had 5.7 million of that going to PSLV, and that's the one where you actually have physical ownership of silver. So again, the traders are getting smarter. They're getting off of those derivatives and they're getting into funds that are closed and managed and have direct exposure to the metal. You can claim the metal. And so we're seeing that shift, and that's really wave two. Wave one was trying to address buying silver through these common market derivatives. Wave two is saying, no, we want the physical. I'm taking delivery of the physical. And again, at Bison Bullion's website, they're actually taking COMEX bars, chopping them up, the 1,000 ounce bars, because of the premiums on the small bars and coins that people typically buy. So not only is this occurring, on the retail side and the small coins and bars, they're actually grabbing COMEX bars. And then this is a scheme in order to get people part of those COMEX bars because of the lower premiums. And I think this is going to accelerate. I've gotten so many phone calls from people, from business owners around the world that are like, hey, can we set up a trust to take delivery on the COMEX and then remelt that into coins and bars and distribute it to people? And I actually have people willing to fund this organization. And it's just been astounding and overwhelming that people are like, hey, we need to get silver for people because they realize there's this demand, and that the average person can't afford, doesn't have experience to go to the exchange and understand those rules and take delivery. So now there's people wanting to set up trust funds to do that. So again, people are going after physical metal, and it's starting to occur on the big exchanges. It's not just on the retail sites.
Right. And for those, again, our viewers just joining us right now, we're reporting right after the May 1st Silver Squeeze 2.0 on the 10th anniversary of the 2011 crash. Now, last time we had this silver squeeze back in late January, early February, we had a big price spike on the Sunday open. And right now we're seeing we're actually seeing it down about 3 cents for silver. And we're not seeing a lot of mainstream media broadcasting about this. When we saw the first silver squeeze, it was a little bit touched on by the mainstream. Can you kind of share with the viewers again your kind of thoughts on why, even though this might even be a bigger, more buying happening, a greater silver squeeze, it's not getting as much coverage and it's not really impacting the price?
It's not getting as much coverage because people aren't buying the typical derivative version of silver that you'll see covered on mainstream media. So if you're watching CNBC or Bloomberg or Reuters, they'll cover the SLV, or in gold, it's the GLD, right? They cover those passive investments into the space in which it's not an actual, you don't actually have physical access as a retail trader to the metal. It's a proxy, because that's what those channels cover. They cover the passive investing, the passive funds, the stocks. So when we're talking about silver buying, they're not looking at Monex's website, or they're not looking at APMEX and looking at physical deliveries. They're not reporting on physical deliveries on the COMEX. They're not reporting on the LBMA issuing a report that they were low on silver because of all this buying into the SLV. So those types of things aren't traditionally covered by them. And I don't think the mainstream media really understands the metals themselves. They think the metals are basically just commodities, which to some extent they are. Silver and gold both have some commodity or industrial demand, but they're not just commodities. They're money as outlined in the US Constitution, Article 10. As far as I know, the Constitution is still in effect. And as long as it is, gold and silver will be seen as money, and they'll be seen as real stores of value over time, as they have been for 6,000 years. And so, but that doesn't benefit the mainstream media. And back when I had my financial licenses, the Series 6, 63, 7, and 3, financial advisors don't like to sell gold and silver because it's hard for them to make commissions off of it. They can make commissions off a lot of these, passive investment funds or stocks. It's hard to make commission off of selling gold and silver. So most of the mainstream financial media is never going to talk about it. And that's why you really have to come to alternative sites like this one that report on these things, where you can actually get the data and you can get the value in understanding how these markets actually work. And so because all of that demand has pulled off of the SLV, the mainstream media is not going to report it. And then now it's going into physical. So the price signals, again, Elijah, aren't going to be there right now. But when we start having big silver shortages, like the LBMA admitted to in February in a paper on their website that I've covered on my channel, and a lot of us have covered, when those actual physical shortages occur, you're going to see upward price pressure. Because let's say you're trading on COMEX and there's no silver available. What's going to happen? Who's going to start taking on? Everybody in the market is going to start taking longs on that contract. That you're going to see that spot price here in the U.S. really pop. And if so much silver is pulled out of the market, the LBMA, it drops from 360 million ounces to 200 to 100, whatever it is, in available physical silver, and they start reporting that would hit the print, that would hit the financial media. And then you're going to see that recognition in the financial sector about that. You're going to see that upward price pressure. The blessing to that, the actual blessing from God to this, is that, Elijah, we have time to get our physical silver before that price rises. So I know everybody wants that price to rise, but look, there's a shortage of real value in this world. Look at the stock market, the PE ratios, look at I was looking at a tweet from someone today who they had an analyst financial report on Tesla. Tesla has more market cap than the rest of the US auto market, but their profits and their capital expenditure was a tiny fraction. So there's no financial reason for Tesla to be the price it is. They don't make enough money. They don't produce enough cars. They don't spend enough CapEx in the market to have the valuation. That's called a bubble. And it's across the US stock market. So we are blessed now to have the ability to go get things of real value, physical gold and silver, while the rest of the market is looking over here, right? Let them blow that market up and let the good people of the United States and around the world get their metals while they can. And that price is going to rise. When that stock market busts, which it will, every 4 to 10 years, the stock market has a major correction. Okay. The bond market's under pressure right now. Look at negative interest rates. Look at everything that's going on with the rising 10-year in the US. Look at the money printing that has gone. Look at the explosion in M0, M1, and M2 in 2020 to deal with the shutdowns. That's eventually going to come home to roost, and you will see those prices rise in the precious metals. But I think, again, wave two, people pulling the physical, and then what's going to happen, you're going to have that delayed price reaction, but it's going to hit the major exchanges this time, not just the retail sellers, and you're going to see that recognition start to creep up in the mainstream financial media.
And I think one of the hardest things to do in any market is to have any sort of timing, right? But in your perspective, essentially, if I'm hearing you right, you're saying the spot price isn't moving right now because it's not, we're not seeing a lot of buying in the future or the SLV and stuff like that. We're seeing a lot of physical buying, and there's going to be this lag between that and the price moving up. So in your perspective, how long do you think that lag will be?
Well, what happens in the futures market? The spot price is determined in the US market by futures trading. It is the settlement prices for each futures contract, the average every day that you can see on CME Group's website for the forward contract. So usually 4 contracts out a month or 2 or 3 because it's a futures contract. It's like oil futures. You're betting on the future price of something. And the way it started, it was legitimate hedging for producers and merchants, but now much more the trading is purely speculative, right? So the pricing signal for that futures market was the SLV and the mainstream media talking about it. Then you would see the managed money go long. You're not having that because remember, people are going out of SLV and getting physical. People got smart. So they get not getting this price signal. So they will eventually get the price signal because it's going to be different this time. And instead of SLV and that signal, you're going to get the exchanges starting to report, we don't have the silver. You've already got the retail exchanges reporting it. People are going to start pulling bars off of COMEX and out of London to get them to retailers and remelting them. That's going to happen. In silver specifically, the biggest price signal is going to be the shortage. If you look at the Silver Institute's report that came out, I believe, in November of last year, they predicted for this year, 2021, that we were going to have an increase in 111 million additional ounces of silver due to industrial demand this year. That would take demand over 1 billion ounces for the first time in silver's history. That is going to be a major pull of silver off the market in whatever form it can be gotten. And that's going to power automobiles, especially EV and green industry. Look at all the legislation coming out about EV and green. Look at the space race and all the silver there, all the applications that silver has. There's going to be shortages caused by this industrial demand. Forget the incremental investment demand. It's going to be the industrial demand. That's going to hit the press. When that hits the press, and what you're going to see is lack of physical. Now that we have taken a lot of the physical off the market, because we're, each one of us is trying to store a couple hundred ounces for ourselves. There are 365 million people in the US and billions across the world. That's going to hit the financial papers. Look at the chip shortage. I just saw an article in CNBC today talking about how Ford is suffering, not able to build cars because of the chip shortage. And that's silicone, and it's in abundance. It's just the supply chain. What happens when silver, which is not in abundance, is not there for industrial applications? You're going to see that reported. So there's, like I said, there's going to be a delay, but you're going to see it, and that's the price is going to spike up. And it's not just going to go to 29.30. You're going to see that 40 and that 50. And when silver becomes unobtainium, like Mike Maloney calls it, when you're in that real shortage, you may see $100 silver and above. So you're going to see higher price levels this time. And the futures market's not going to matter. The cat's going to be out of the bag. Everybody's going to go long futures. You're going to see that price reflect that. And that's what happened in oil not too long ago, about 8, 9, 10 years ago. Oil hit something like $140 a barrel. That was on what they perceived as a supply shortage that ended up not being a long-term supply shortage. Silver and gold's different. Silver especially, there will be a long-term supply shortage. So I think silver's move is going to be bigger than what we saw in oil 8, 9, 10 years ago. I think it's going to be a much bigger move, and I think it's going to stay around for a lot longer.
I think the industrial demand aspect you point out is really interesting because silver is so useful. It's the most conductive metal, right? And it's so useful in so much technology. And with the green energy initiative by Biden, it seems like demand will even just increase. And the interesting thing is if the price of silver increases, it's very inelastic, right? The demand, because it's not like they're just not going to use silver anymore. You need silver for industry.
That's exactly right. The price inelastic because silver is used very minutely in everything. So if I grab my iPhone here, there's a little bit of silver used in this iPhone. And the reason they use silver versus aluminum, copper, or gold are different reasons. Gold will do most of the things that silver do. It's the second most conductive element, and it's very malleable, but it's very expensive. So if you were to substitute gold for silver in something like this, yeah, these would all get a lot more expensive. Aluminum and copper, they're not as conductive for very thin applications like on these electronics. So you can't substitute. So you got to use silver, but there's only a certain amount used in here, right? So think about the billions of these produced every year. Think about all of the millions of solar panels produced every year. Think about the digital cameras, the computers, anything electronic uses silver. Medical implements use silver. I said last time I was talking to you that I think 500 ounces of silver goes into the average warhead that the US uses in their military. You can't replace all the applications of silver. There, you can substitute to an extent, but you give trade-offs. And unless we want to go backwards in terms of our technological development, you've got to use silver. So everything's going to use silver. It's inelastic demand because a little bit in every application. And then, so that way, even if silver went, from $30 to $100, this will go up by 30, $40. It's not going to tamp consumer demand that much. But when you multiply that by the billions of these produced every year, iPhones and Androids, then you're talking about, a huge pull on silver, which is going to really increase that price. And that's really what makes silver so unique. And that's really the long-term value proposition for investors in silver is they realize all these facts. They realize that price inelasticity and that demand and that lack of adequate substitutes. And unless you get the entire world to go backwards in technology and go back 10 to 20 years, I don't see that demand for silver waning. I don't know how it does.
That's very interesting. And also during the first silver squeeze, we also saw a lot of demand for gold. Do you see a similar thing this time with the second silver squeeze May 1st, move into gold as well?
I've been telling people that definitely if you want to invest in precious metal, get your silver, but don't forget about gold because gold is so important. Gold right now is being, the amount demanded by central banks is amazing. There was somebody again who I follow on Twitter, excellent analyst, who printed a chart of central bank buying of gold since the last financial crisis. The net buying of central gold has been absolutely ridiculous. And we're hearing reports that both China and Russia, the central banks are buying gold, but they're storing in their sovereign wealth funds. So they're not reporting official gold reserves. And that was in news from China and Russia. There's official news outlets from those countries. So they've actually got more gold than they're officially reporting. So why is everybody buying all this gold? Why is Hungary repatriating it? Why is Brazil trying to repatriate it? Why is Germany trying to repatriate it? And why are all these other countries trying to buy as much gold as they can for their central banks and to support their currencies? Well, you've got Basel III. So Basel III is a set of regulations and guidelines for the banking industry, which talks about reserves and how you want to boost up the reserves in the banking system so to pass these stress tests. And because they know that the business cycle is cyclical, they know the next recession is coming. They don't want the banking system to collapse. So cash is king in the banking system as a reserve. Gold has been upgraded in Basel III. As long as you have allocated gold storage, meaning a bank owns it in their name, they're not going through the unallocated OTC market in London. They're not doing derivative exposure in COMEX, but they have physically allocated gold and it's hedged. They have a legitimate hedge. Then it's considered as good as cash in terms of reserve requirements. That's one of the reasons. So if the fiat currencies are going to come under pressure, then what the central banking system knows that as they come under pressure, especially if they're dollar, if you're euro dollar deposit or Chinese dollar deposits, and that dollar keeps coming down, that dollar index is coming down, they need something more stable over time, and gold is that. And so they're starting to stock up on gold, and that's part of the Basel III reserve requirements, the NSRM and the other liquidity ratios. So gold has become so much more important to central banking, to the banking system overall. That's why you have tremendous demand by the central banks. And then I think individuals are stocking up on gold as well. Now, silver is getting more attention right now with Wall Street Silver and the silver squeeze movement because it's a smaller market than gold. There's more gold available, but that's going to spill over into gold. You're going to see that demand start to spill over in gold. And I think when we start to get reports of silver being physically short, people are going to go to whatever precious metal they can. They're going to go to gold. And something I predicted, they'll get into palladium and platinum a little bit as well. We've seen renewed interest in platinum. I see palladium recently hit $3,000 all-time high. So in industrial demand, but I think there's going to be some investment demand in those secondary precious metals as well. So I think that silver is going to spill to gold, and then some will go into other things as well. I think we're going to see that over the next, say, 6 months to a year and a half.
Fantastic. Well, once again, we have Robert Kientz from goldsilverpros.com with us today. We're just going to have a couple viewers' questions before we end this live stream on the Sunday Open after the May 1st Silver Squeeze. So the first comment actually we have here is the spot market is not the silver market. Your take, Robert?
Yeah, the spot market is not the silver market. Two ways you can look at spot. There's an AM and PM fix on the London market where the banks come together and they set price fixes for the day where they think the price should go. And that's kind of the target of the trading. And then on COMEX, you have the futures deliveries, which determines the US spot price. And there's an arbitrage opportunity between the two. And a lot of people play that through the exchange for physical mechanism, which we saw blow out last year after the pandemic hit. And gold, that exchange for physical arbitrage blew out for about a month or so, and silver, it stayed there for 3 or 4 months. And it blows out because it depends upon the individual amounts of physical available versus the dynamics of that market. But those markets, again, are derivative traded. So if you look at the amount of silver and gold produced in the world every year, the derivative markets trade more paper than is physically produced every year. And specifically in silver, I've seen on certain days enough derivative paper traded on the COMEX that equaled all the ounces the miners produce in an entire year. And that doesn't make sense, because if you're a legitimate hedger, a producer or merchant, you're hedging your position either long or short, your exposure to that price. You're a producer and you're going to produce it and sell it, so you're worried about the price going down. Or you're the merchant and you're going to buy it and use it and you're worried about that price going up and raising your input cost. Okay, you want to hedge that for maybe a couple of 3 months as you plan your business. You're not going to take that hedging position in one day for an entire year. That doesn't make sense. Nobody really does that. So the amount of paper trade on these markets dwarfs, what we see in COMEX. And again, the LBMA admitted that the paper derivative position dwarfed the actual physical silver in February in their paper. So we know that those derivative positions are really a fractions hedging, but most of it's speculative. And that's not the same as the actual physical market. They're two completely separate things. And I can't emphasize that enough. When people see that price printed on their computer, that's not the physical market. It's a completely different dynamic, what you're saying.
Now, we have a few viewers asking and really commenting about how, like, if you don't hold silver, you don't own it. Your perspective on that?
There are some ways to safely store, and I'll get at that in a minute. I would say if you have it in your possession, and I'll grab a piece here real quick. I'm just going to grab a coin that I just have sitting at my desk. One silver ounce has a Chinese yin and yang feature on it right here that you can see. A really cool coin. There you go. You got yours. So Canadian maple leaf, one of my favorite. Beautiful coin. Holding it, yes, in your possession, you own it. There's no counterparty risk here. I've got it. I can sell it. I can store it. I can do whatever I want. You can go to storage places to store. You've got to be careful. One thing I wrote in my subscription newsletter website called the Golden Quarterly. Every quarter, we do a subscription service. One thing I wrote in the spring edition that came out not too long ago, a few weeks ago, I said, be careful, because there are reports coming out about certain providers of stored metal in which it's not allocated and segregated directly to you. It may be an unallocated position, which means they either have it or they don't. And if you're the first one to go get it, good for you. If you're the 10th person to go get it, you may not get any. It's kind of like a bank. If you go to a bank and you say, I demand all the $50,000 in my account, those tellers don't have $50,000. And that's called a bank run. And we saw that during the Great Depression. And we've seen that since. The banks keep a fraction of that cash available. They use the rest to invest. Same thing with these unallocated gold and silver accounts. They're basically saying, yeah, we'll take your money, but to actually get you the physical gold or silver, we have a little bit, but then you may have to wait because, we have to go get something more from the refinery, when it's available next month. And so if you actually want to get your physical with these unallocated accounts, unless you're the first person there and, you're not storing a whole lot, otherwise you're going to bankrupt what they have on the back shelf in their office, right? They don't have a big vault. That's unallocated. There's allocated schemes, or which pooled allocation, meaning you buy a bar, they have all the bars, that people have ordered. But if you're buying a fraction of a bar, that bar belongs to a bunch of people, and to liquidate it is very difficult, right? And so they may not be able to get it to you. It's not segregated in your name. It's all sitting in the same cage in the same warehouse. And so there may be a delay in getting it. So if you want access, having it in your hand is best. The safest gold storage is allocated and segregated. So they have the bar or the coin in your name, segregated in a different bag or a different box sitting there, and you have right to go drive and pick it up. So in some cases, yes, it can be safe to store, but you got to be really careful. Read all that documentation. There's a lack of regulation in this area so that you can read a claim by a company and you don't really know the truth. You literally have to get down to asking the right questions. Every company is different about reporting what type of account you have. So just be very careful there. So this is the safest way. There are ways to store it if you want to buy it and don't want to have it at home. You got to be super careful about who you're buying it from. And it can't just be a name that everybody throws out there. You got to do your due diligence and ask questions.
And I think it's really interesting. Like, yeah, the safest way to own precious metals, you're saying, is having it in your hand. You can hold it and you know it's here, right? Well, I think that's really a good point. And the one thing about precious metals is like it's you own it to reduce risk, right? And it's like, right, how can you have less risk than if it's completely outside the financial system? I think that's right. It's such a good point. Now, with respect to these, like the Canadian maple leafs, the other coins that are out there, and really any of the physical bullion in, anything 100-ounce bars or less, there's really high premiums right now. And people are asking about that, like historically, how high are they and what is your perspective? And that kind of gets into the other question is like, is the spot price the actual price of silver? If you can't get, a Canadian maple leaf for, more than like $5, $6, $7 over spot.
Whenever you see the premiums in retail rise above spot by, $7, $8, like on an eagle that we're seeing right now, that's your sign that spot, it has nothing to do with physical. Because if it did, then the spot price would go up. No, it's the derivative trading. And again, going back to that report from the LBMA, the London OTC market, when people were pulling silver, we were buying SLV shares and it was pulling silver out of the unallocated account, they almost ran out. Okay, because all that OTC trading is just paper on top of a very small amount. So when you have a bunch of paper on top of a very small amount, you cannot get true price discovery. It's synthetic supply of the precious metals. It's not real. So when you see those retail prices go up, that is more of a reflection of the current demand for those metals. And that, and what we're seeing is some of the more common coins, American silver eagles, have the highest premiums to them. There are ways to get it a little cheaper. You can go with like a regular bar, like from Sunshine or Perth or whoever. You can go with a regular round. There are ways to get it a little bit cheaper. The more silver or gold you buy, the bigger bar sizes, the premium tends to come down. And you just kind of have to shop around. So you go to your favorite website, call Miles Franklin, if you will, go to your other favorite website, look for deals, but generally it's going to be in the bars and the generic rounds over the government minted coins. The American silver and gold and eagle probably have the absolute highest premiums. I remember years ago, I was buying pre-1965 US coins, which they call junk silver, which has, 40 or 90% silver in it for just like 1.5% over spot. Okay, you can't get that for 1.5% over spot right now. The demand's too high. You're paying 10, 15, 20, 25% premium, 30% premium. And again, that's a more realistic measure of how much demand there is for the physical.
I think that's a really good point. And right here, I have a 1 ounce round. You can see it, one of the Buffalo rounds. And I know I've talked to Andy Scheckman from Miles Franklin about this and how really the premium on like a 1 ounce round, it's simple. It's not, it's not a government mint. It's lower premium. Like the premium on a 1 ounce round, if you want to really know the real price of silver, that might be a more accurate price of silver. Your perspective on that, or even if we go to like the 1,000-ounce bars, the premiums on those. I mean, what do you think is the most accurate price of silver right now?
So if you want to know, I would say it this way. The 1,000-ounce bars probably accurately reflect industrial demand until they run out. The smaller ones are the retail demand. That's investment demand. So the best proxy in the US for investment price of silver as an actual asset is going to be the spot plus the premium of an American silver eagle. It's one of the most popular ones. It's what people go to when they're worried about the financial system. They go to that American Silver Eagle. So I would say it has the highest premiums. That's what people, when they fear the monetary system, that's what you're going to pay. And I think over time that price will hold up. But you're right. I mean, you can get it in some of the more generic rounds and things, but that's not the first thing people want. So I would say investment demand, look at the American Silver Eagle. Industrial demand, look at more the 100 or the 1,000 ounce bars. And that's what the industrials are going to pay for it. Although I do think that that's going to increase over time as well.
All right. Well, Robert Kientz, we really appreciate your time today. If people would like to hear more of these interviews, they can go to libertyandfinance.com, sign up for the free email newsletter. You'll get all the interviews, all the descriptions, and everything you'll need for all the new interviews coming out on this channel, or you can simply hit the subscribe button and the bell icon. Your website is goldsilverpros.com. Tell us a little bit about that.
Right. So if you go to goldsilverpros.com, every time we do a video, there's a free newsletter. You click on the newsletter link. All you do is put in your email. We'll send you out a notice when we're doing a video like this on your channel or on our channel. There is a subscription service if people are interested. We do a quarterly newsletter as well as a university, which is a set of courses that we designed to help you understand the precious metals and the financial markets and to help you make better decisions there in terms of your financial future. If you're interested, sign up at goldsilverpros.com.
Awesome. Robert, before we let you go, any last thoughts you'd like to leave with our viewers with respect to this May 1st Silver Squeeze?
I want to thank all the viewers of your channel, our channel, and all of the PM community for all of the support that we receive. You guys are why we do this. We couldn't survive without you, of course. And I love to see all the enthusiasm. When I first started in this 10 to 12 years ago, I felt alone. I was the only guy out there. Now I see people in the local restaurant and they're talking about, what do I do to protect my financial future? And I bring up gold and silver and they're like, tell me more. So there is an awakening here and it's you guys doing it. We appreciate you so much. Thank you so much for tuning into this broadcast and all of our broadcasts. You're the reason why we do it. And we thank you so much.
Fantastic. The website is goldsilverpros.com. Our website, libertyandfinance.com. And if you would like to acquire precious metals and support Liberty and Finance, the information is in the description of this video. Once again, everyone, thank you for joining us. And Robert, thank you so much for your time and God bless.
Thank you again, Elisha.